Welcome student to this live virtual classes session for May 2026 examination target for the paper Advanced Financial Management, that is paper number 2 final level. ICAI Ashish Gupta, Joint Director Board of Studies, welcome to you all. Students, first of all, I sincerely apologize for this delay due to some technical issues. Now student, since this topic paper is very scoring one, so I request you, good morning, Megha Beta. I request you all that you should go through this paper very well, because this is a very scoring paper. In a previous attempts, even student have scored 90 plus marks even in this paper. So student, in this paper, the major part that is kept to be mind in one or two, three uh, tips I want to share with you. Of course, for the securing good marks, we have a separate session BUS for the success and success at BUS, etc. We have many programs are there. But once you have to keep in mind, of course, it is a numerical based paper, but please don't be in such a misconception that it is purely numerical. Of course, the theoretical portion are as well as there, and even so, though some topics are theoretical dominated, say today's first topic that we will discuss in class is a, although it is a theoretical topic, but some numerical portions are also covered in it. So student, please try to understand. We have to be very conscious while we are making our preparation. Now I am starting with my see. So far as the class notes are concerned, you may be aware that BOS has come out with the Saransh, the last mile referencer for the AFM, that is Advanced Financial Management as well. So my request to you, please refer the same, because it is containing the summary of, or you can say brief points of this main study material. But please remember that I am again requesting everyone, it is not the replacement of study material in any case. You have to do the study material at any cost. So please don't ignore it. Okay, it is my sincere request. So I am starting with my presentation just now. Just have some patience. Ashokji, screen is visible to everyone? Yeah, I think. Okay. Yes. Yes. Okay, now it's okay. Okay. Okay, students. Now, when we talk about this topic of advanced financial management, so it is basically, we can say that the topic that we have covered at the intermediate level, that of financial management, we can say it is a kind of an advanced version. However, there is one very important aspect in this topic, that is we have to take some strategic decisions. Now, the topic start with the first of advanced role of CFO in various matters, including value creation. Students, if you recall that while you were doing your intermediate topic of financial management, there were two subject, we can say two objectives of the financial management were there. That is, first is profit maximization, another is wealth maximization. So far as the profit maximization concerned, as you may aware that it is kind of a, we can say it is a kind of a vague. There are many shortcomings in this kind of objective, because uh, profit is a vague term. Okay. Then another point is that sometime while maximizing the profit, we ignore the risk. So due to some or two or three reasons, we switch over to the wealth maximization objective, where our objective is to maximize the wealth of shareholders. Of course, it is one of the very important objective. But now, with the passage of time, the role of CFO, or we can say earlier it used to be called, traditionally used to be called finance manager, but now they are used to call CFOs. Now, CFO hold a very dominating position in the organization. So, due to this reason, now their role has been multifaceted, or we can say it is a multidimensional. Now, when we start with the advanced role, because this role has been increased multifold post-COVID era. While in the post-COVID era, the role has been, it has been identified that the CFO's role is not only limited to keeping the finance affair, rather they are, we can say, they have been start involving in the business, or we can say leadership role of the for the company. Now, when we talk about the risk management, first of all, nowadays the every CFO are expected to uh, come take care of the risk management aspect as well. Okay, risk management. What is risk management? Okay, now what is risk? Because it is one of the second number chapter in our syllabus. Risk management is basically kind of a to we can say to estimate the something failure is coming, and we have to combat it. Okay, it is very important that risk management is a very broad spectrum. Okay, it includes your operational risk, it includes your financial risk, it includes your uh, we can say that there are other kind of risk, geographical risk or political risk. There are many risks are there. However, since we are studying the topic of advanced financial management, our concentration should be towards only the financial risk. So here we shall concentrate our discussion towards financial risk, and in the forthcoming chapter we shall see that we are mitigating the financial risk. Now, next role comes the CFOs is the supply chain. Now, supply chains importance has been increased we can say exponential growth in the supply chain concept has taken place post COVID era, because in the during the COVID era it was a supply chain management was there that played a very huge role, or we can say very crucial role in supplying the goods to the customers, because when there were all things was shut down, so it was a supply chain management that makes us the goods available at our doorstep as well. And even due to this reason, many companies has earned a huge profit. Okay, now next is coming merger acquisition and corporate restructuring. Now, student, we will see further that nowadays, earlier there was a time when a company used to establish a new business at their own. Okay, what they used to do, they used to set up a unit, then employ the staff there, then capture the market. Slow process was there, but now nowadays what is happening, any big company is acquiring a small company to diversify into the field. Okay, or even we can see that it is called we can say it is a we can say that it is a kind of a conglomerate type of a merger. Okay, where they want to diversify or they want to increase the spectrum of their business. And even there are some other kind of a mergers, like they are acquiring the computer business. Okay, in this case they are gaining the market share, they are gaining the market share, and it is, and after the gaining the market share they becomes a market leader. And even sometime it has been observed that merger acquisition take place to acquire the, we can say, supply line. Okay, suppose a company is manufacturing some product and they need some raw material. So it is, since it was dependent on any other company, what they are doing, they are acquiring that company so that they can ensure the quality as well as free flow of the supply. So these kind of a decisions now it very important for the CFOs. Now there is another aspect, that is ESG. Nowadays, it is now very important that it has to be. It has come into now with in the recent time. Of course, wealth maximization, profit maximization objective is the company's objective. But now it has started realizing that it is also very important to consider where we are working, where place we are working, and for whom we are working. It is also need to be taken into care. So accordingly, where means environment. Okay, we have to take care of the environment as well. Okay, sustainability. Okay, sustainability means we have to maintain our that has to be on a same some growth has to be maintained, or we have to survive for a long time, or even sometimes it is also called social. Social means environment, environmental means place where we are working, social means with whom we are dealing, it can be employees or it can be customer. Then it comes the governance. Governance is very important because it is the governance that drives the business. So we have to ensure that all these three pillars are strongly inbuilt in the company, and accordingly, while we are deciding any financing, so it has to be taken. These three aspects need to be taken care as well. Now there is a concept of green finance is coming into the picture nowadays. Okay, so green finance as because it is meeting the requirement of ESG. So this type of a concept nowadays are evolving, and accordingly, the role of CFO is also we can say attached to this concept as well. Now, when we talk about strategic financial decision making framework, okay, these are the very important points. We can say that these are the three important points where it is very important that a clear, realistic strategy should be there. Okay, because we should have a strategy in our mind that what we have to do. Okay, it is one of the very prerequisites of the strategy that what is in our mind, it has to be taken care. One second. Okay, because it is very, then we have to see what are the financial resources that are available with us. Okay, it is very important that we have to see out that what are the financial resources are available, and then very important, right management team. Okay, because if both are there, we have a strategy, we have a finance as well, but our management is not that much of competent. Of course, all these things will be going to the waste. So this is one of the very important aspect. Next, it comes now when we talk about this strategic decision making. So there are one or two things that we have to keep in mind. Okay, because we have to see, we have to see sustain the very important point here. Sustain increase in investors' return through continual investment opportunities. This strategic financial decision making is very important, even it is a fundamental business because the student, now the time is changing very fastly. Okay, there was used to be a time when business were say we can say moving slowly. But now what has happening? If you have established a product, then you have to take care that you have to, if with the changing of the time, you have to change your investment opportunities. You have to look out for different investment opportunities so that you can make the profit or you can sustain. Okay, because if you want to search anything now, very simple example. As a chartered accountant, when we have passed our CA in way back in 90s, somewhere around 90s, so at that time there were no computers. Okay, so with the passage of time, when we around say somewhere in around in 2000s, so we have to learn the computer. Okay, because we have to maintain ourselves and we have to keep updated. So that is why, and similarly for a business, it is very important that we have to sustain the increase in investors through funding the seeing the looking for the investment opportunity so that they can sustain it. Okay, so it is very important that these are the three important fundamental essential elements. Okay, students. Now we come to the meaning of the strategic financial management. Okay, so first of all, it is defined as the application of financial management technique to this strategic decision making. See, we have studied financial management techniques in our intermediate level. Okay, now we shall use here it for the strategic decision making to achieve the decision maker's objective. So this strategic decision making can be like merger and acquisitions. Okay, so for this to related to your evaluation. Okay, how much we should need to pay. Even we can say there are various kind of a decisions that we have to take. So all these are when we apply the financial management technique to for taking the strategic decisions, then it calls the strategic financial management. Now, very important, it combines the backward looking and report focused discipline of financial accounting with some more dynamic and forward looking subject of financial management. Now, student, it is very important. First of all, it is report focus. When we talk, say that it is a report focus. So what are the report? Because we have to rely on the reports such as income statement, okay, balance sheet. All you know that it is these are the kind of a financial accounting statements and cash flow statements. So all these are basically forms the basis of the our forward looking. Okay, because on that basis, because income statement now in today's assignment we will also see that from some income given income statement we assume that there is going to be this much of increase in our sale, so accordingly we have to make the financial planning. So all these things are interrelated and these are the bases. Okay student, so now another is very important aspect is forward looking. Okay, one another aspect is forward looking. So when we talk about forward looking, what we say when we say it is a forward looking, okay, we have what we have to do. We have to prepare the budgets. Okay, we have to make forecasting. Okay, when we if you recall that in the financial management when we were discussing the topic, so we used to estimate this will be our cash flow or this will be our profit. So all these are kind of a investment forecasting, and on that basis what we do we make investment decisions making, and this is basically capital budgeting. Okay, then forward looking means we have to also anticipate the risk, what risk we are likely to face. And another aspect is working capital management. Generally, if you recall that we need to prepare cash budget. Okay, cash budget was one of the very important part of the working capital management, where we estimate the sale, then we estimate the realization from the debtors. So all that we have to prepare. So it is one of the also important part of the our. So this is kind of a forward looking. Then when we talk about the more dynamic, okay, we can say constantly respond to changing environment. Okay, see what happens. Unlike accounting, which is basically rule based. Okay, financial management involves strategic thinking. Okay, it is very important. It is involve strategic thinking. Okay, judgment and adaptability. See, when we talk about the accounting, in basic accounting, there are set rules. We have to follow like three rules of the journals: debit what comes in, credit what goes out, debit all the income and expenses, and credit all the gains, etc., and debit the receiver, credit the giver. So all rules are somewhere rules are there. But please remember, this is a rule based. Okay, but in when we talk about the financial management, it is more dynamic in the sense that of course some data may be before us. I may be interpreted in some manner, different manner, you may interpret this in a different manner. Okay, and that's why if we say that now sometimes we will see sometimes even in strategic financial management decision making we have to even accept a project that is loss making, but we have to accept because it will lead to increase in the profit or we can say revenue in the other projects. So we have to make a proper cost benefit analysis, and we have a broad cost benefit analysis so that we can think in a wide spectrum. So this is very important. We have to see strategically and make judgment. Unlike our accounting, where we have to just go by the data. So this is one of the important part of our strategic financial management. So student, when we are starting our topic of advanced financial management, but our purpose is to make the strategic financial decisions. So we all this point need to be kept in mind. Sometimes because in the questions we are asked to give our comments. So in that comments we have to take care. We have to make judgment based on our analysis. Now, very important. Student, if you have any query, you can ask through the chat box as well, no problem. Now, when we talk about strategy at different hierarchy level, so basically there are three hierarchy levels where we have to make the strategy. Okay, we can say that there is one corporate level, then there is a business unit level, and there is a functional unit level strategy. So all these are strategies are very important, and we can say it is a forms the basis of our financial management. So now we start with the corporate level strategy. 1 second. When we talk about corporate level strategy, it is basically a strategy. We can say that if we see that we have to see three criteria in mind. One is suitability, feasibility, and acceptability. So basically, corporate level means when any company is making any strategy on a corporate means top level. Okay, because see here, if we read the first line, fundamentally concerned with the selection of businesses in which the company should compete and should be able to answer these three basic questions. Now, it is very important because when we talk about corporate level, it says, first of all, in which business we have to enter. Okay, sometime a company may be doing some business, but they want to do some other business. So it is one of the very corporate level strategy decision. And in this decision, they have to see 3 points: whether the strategy would work and accomplishment of the common objective of the company. What is the common objective of the company? It can be anything. Okay, it can be social objective or it can be profit objective, whatever it is. So they have to analyze whether this will be suitable for us or not suitable us. Okay, then it has to see the feasibility. Okay, because it is very important. They have to see what are the number of resources are available. Okay, of course, they have said that I want to go for a strategy, but they have to see whether the resources are available or not available. It is concerned with the stakeholder satisfaction and can be financial and can be non-financial. Now, acceptability is very important. Okay, of course, sometimes it has been seen that the shareholder may say yes to any project, but it may not be environment friendly. Okay, and it may not be environment friendly. In this case, the society which is one of the very important stakeholders, may say no to the project. It may not be beneficial so it is very important because so it is a non-financial consideration. So it is should be acceptability need to be assessed whether it is acceptable to the society or not. So this is another criteria. Now, when we talk about the corporate level strategy, sometimes some example can be we can refer. Like I'll just give you a very small example, 1 or 2 example or 2 or 3 example. Like for growth, it can be the strategy of the company, growth through acquisition. As I told you, sometimes companies are acquiring companies through the entering into the new business through the acquisition. So in this case, there is one very good example when the Tata Group acquired the Jaguar Land Rover. Okay, to enter into the segment of luxury cars. So this is a corporate level strategy. Similarly, diversification. When we talk about the diversification, and a good example is Reliance Industries. Okay, when it moved from oil and petrochemical to telecom, that is Geo. Okay, retail. Okay, and even media. So we can see the n numbers of examples are there where they have diversified. These are all corporate strategy. Even like one of the very another example, good example, stability strategy. They want to maintain the stability. What the Coca-Cola has done, they have concentrated on the beverages, concentrated on the beverages product they are providing. Okay, and they have come out with the to increase the acceptability, zero sugar beverages. They have come out with it. So all these are steps are corporate strategy. What I want to say with you, discuss with you. That is all the examples of the. Okay, students. So I hope it is clear to you. Now, student, please try to understand. Of course, this is a theoretical, but this theoretical discussion will help you to retain the points, and as well as help you to give a broad spectrum to your decision making. Okay, now next comes the functional level strategy. I don't need to discuss with you what is, sorry, it is a business level. Sorry, I'm coming. Business unit level strategy. Now, when we talk about business level unit strategy, it is basically, we can say that taking the competing advantage. Okay. Business unit strategy generally concerned with the from the rival units. Okay. So how we can be the better than others, we can say that how can we be the better than others, it is a, so we can say consider in this way. So we have to make some differentiation. Okay, we have to create some differentiating point or differentiation. For example, I just give you a very simple example, like Big Bazaar. Okay, they have come out with the cost leadership. So their objective was cost leadership. Through cost leadership, what they have done, they have lowered the prices and high volume. Then Apple iPhone. What is the unique feature? They are different. Okay, unique value, unique features, and it is a basically premium that they carry. Okay, then innovation. For innovation, we can take the name of Tesla. So what is their basically they do the technology leadership. they come the first. Okay, they are investing in what is likely to be in the future. Similarly, we can say the McDonald's India. Okay, operational excellence. Okay, clean environment and local taste like Mac Burger Aloo. I think there are some Mac Burger Aloo Tikkis there. Okay, so we can see that by introducing like Aloo Tikki, it is because of it is as per Indian taste. So they have taken this adapted this strategy so that they can outperform the other because we are the best. Okay. Now we come to the last strategy of the level, that is functional level strategy. Now, when we talk about functional level strategy, it is basically the level of operating divisions and departments. Okay, it is the level of divisions and departments. Okay, and related to the functional business process and value chains. Among different functions, activities like production, marketing, finance, human resources, and research and development, highest importance during the top-down and a bottom interacting of the planning. So now we can say that these are the bases which interact with the we can say down. From the top to down, it is a basically a linking pin. Okay, they interact with the most junior management, and they can also interact with the senior management. So somewhere they are between. Okay, now it is very important that they play a very big role in a development. We can say we can say to doing the best. Okay, or meeting the objective of company. Like for example, I just give you an example. Functional. These are the functions. Okay, now the company say I'm just writing company's name, or and what are the strategy they have adopted. Okay, result. Okay, now when we talk about function, for example, in marketing function, if I talk about the company say Amul. Okay, what they have done? They have done the emotional branding with Amul Girl. If you see the Amul Butter, so they have what they have done with Amul Girl. So they and the result is that accept nationwide acceptability. So these are the strategy. Okay, when I talk about say HR, if I say that take the name of Infosys. Okay, what the, if now it is called Infi. So what they have done, they have made the investment in human resources. How they have made the human resources? They have established a global education center where they train the engineers for the best. Okay, so strong talent in pipeline for them. They have a strong talent for them. They need not to look anyone. Okay, so all these are examples where there are many examples can be possible there. So we have to see what are the functional level strategies that can we adopt so that we can we can meet the business as well as corporate level objectives. Now I'm coming to the next one. One second. Financial planning. Now, financial planning, it is one of the very important aspect of the strategic financial management, and it consists of three resources. One is financial resources. Okay, then is a three aspect components. Then is a financial tools, and what is our financial goal. So all these are basically we can say three pillars of the financial planning. So let us see what is first pillar, financial resources. Now, when we talk about the financial resources, they are the basically mean to achieve the goals. Okay, this funding can be, we can say, it can be funding can be our internal, resources can be our internal, or these can be our external. When we can say it is a internal, so these are come retained earning. Okay, depreciation reserve, because depreciation is a kind of a known item. Then sale of any asset, or non-core business. So these are internal sources. When I talk about equity external, so it comes the equity, fresh equity. Okay, debt. Okay, venture capital nowadays. One of the very important is venture capital nowadays. It is coming. Oh, okay, subsidy from the government. So all these are our external sources. Okay, so because it is why it is so important, why the financial resources are so important, because it lets us know how much we can invest. Okay, affects or impacts the liquidity, solvency, and credit worthiness of the company. Okay, it is very important. Now, when we talk about the resources, it is also important because the decisions for the resources also helps to secure the liquidity, solvency, and as well as fund. So now when we talk about the liquidity, if you recall when we are talking about the liquidity, the cash management, or we have to see from what sources we have to arrange the funds. Okay, so that we should can maintain the liquidity and as well as we should maintain the solvency, because too much debt, too much relying on the external debt, and that can be the impact the solvency of the company. And then it is very important for budgeting. Once we have a resources, then we can see how much we have to budget for the same. It is very common when we in a home also, when we are planning anything. So it is our financial resources that let us know how much we can, or what decisions we can take. So this is one of the aspect of the financial resources. Now I am coming to the financial tools. Okay, financial tools basically offers the, okay, it offers the methods to analyze, plan, and monitor. Okay, so this can be, we can say that like we can divide it into three category somewhere. Like these are analytical. Okay, these can be our planning tools, or these can be our valuation. Okay, like for analytical reasons, you remember that there was some ratio analysis. Okay, break even analysis. Okay, trend analysis. Okay, for planning, it can be budgeting, forecasting. Okay, so this kind of, and for valuation, it just for valuation I'm writing separately. There are many methods like NPV analysis, okay, IRR analysis, okay, payback period. So these are for the purpose of the valuation WACC. Okay, so for valuation, even we can use the Excel, ERP software. So all these are come under here. Okay, now next it is we are coming to the financial tools. After we have come to the financial tools, we come to the last, and this is called financial goals. Now, when we talk about financial goals, it can be our short term and long term, medium term and long term. Okay, when we talk about the short term financial goals, okay, this can be main the liquidity, okay, controlling the working capital and monitoring the cash flow. So these are the normally very short term objectives of the financial planning. Okay, now when we talk about the medium term, okay, it is reducing the debt. Okay, then improve ROE, return on equity. Okay, or we can say optimizing. So these are one or two three objectives are there. So when we talk about the long term, it is basically concerned with the sustainable profit, sustainability in the profit or growth. Okay, so it is very important that because once we are clear that, and there is one more important maximization of the shareholders' wealth. It is one of the very important. We cannot ignore it. So we can see that all these are long-term objectives of our financial planning and importance. We can say that it helps us to achieve. We can say it also helps us to, and you can say it will coordinate with the business strategy if we keep this objective in our mind. So all these we can say that. Uh, and now when we talk about the relationship, okay, when we talk about the relationship, how it is related, financial research. Okay. Now let us see what is the relationship between this. Just quickly from this, I'm preparing one and nine. How it is related to each other. So we can see that now if our component, I write here component financial resources. Okay, it provides a means to achieve the result. So mean is the basic point. If I talk financial tools, then it offers the methods to analyze and plan. So it is the methods. Okay, when we talk about the goals, it defines the targets. So it is a target that is very important that we have to achieve. Okay, student. So I think there is some chat in the chat. Okay. Okay, student, now we are coming to the interface of the financial policy and strategic management. That is one of the important talk. That is, we can say, it is one base of the this chapter. Okay, so when we talk about this interface, if we read these points, these are very important points. The starting point of an organization is money, and the end point is money. We start with the money and the form of acquiring the funds. Okay, and we are acquiring the funds, and ultimately, what we are doing, we are paying back in the form of dividend. So we can say that starting point of the business, any business is a money, organization is money, and it is coming out with paying the money in the form of dividend. However, we can say that some non-profit organization are exception to this common phenomena, because generally, of course, they may acquire, start with the objective of money, but ultimately their purpose is to doing the social welfare. Okay, so there can be exception to it. Then sources of finance and capital structure are the most common important dimensions. So finance, sources of finance and capital structure, because it is basically relating to our WACC. Okay, if you recall that in the intermediate level, these two topics were very important. Okay, what are the various sources that are available? But nowadays, even it is very important that not only the domestic sources of fundings are there considered, even international sources of funding are also considered, like our capital, like IDA. We shall discuss American Depository Receipt, Global Depository Receipt are also coming into the picture. Now, another important dimension, dividend policy, yet another area of making the financial policy decision affecting the strategic performance of the company. Now, basically, this dividend also determines the sustainable growth. That is the next point of our discussion. Okay, that is our next point of a discussion. Now, because it is also depend, because sometimes if you recall that there is one model in dividend, I don't know, it has been covered in intermediate level, Walter's model, where if the company is earning at a more percentage than its cost of equity, of course, we say company don't pay the dividend at all, because it leads to the growth. But if the company's ROE is not that much, okay, that it is less than our equity, so then in that case, in cost of equity, then we have to ignore it. We have to see that company may pays the 100% dividend. Okay. Then it is comes up financial policy of company. Another important policy of financial interface, that is investment and the fund allocation decision making, because we have to see, we have to design some financial policy that how we have to allocate the funds. Okay, it is very important, because if we don't have any clear-cut policy, then we can face some challenges. Okay, because we have to see how we can move further. Okay, financial policy of a company cannot be worked in isolation with the to other functional policies. It is very important. Now, functional policies, it is, I give you a very small example. Generally, there are kind of a functional conflicts are there. I just give you a very practical example, because I think I remember when I was working in a corporate. So what used to happen, the marketing department were given the challenges, they were given the targets for achieving some sale quarter wise. So in this case, what they used to do, they used to sell the product to those parties, even from there the recovery chances of recovery are least. Hence, the chances of bad debts used to increase a lot. So since I was in their department, so I raised objection in the meeting that our marketing department is making the sale to the customers which already has a bad history. So then it was, I have to face a lot of heat from the marketing department, but we have come out some compromise, of course, and we have to one way out. Of course, we shall that not sale can be made to these people because it will lead to bad debts. So this is the conflict is there. So we have to work in not we cannot our financial policies cannot work in isolation. We have to also consider other functions as well. The next is corporate strategy is not the is the cause and financial policy effect, and the sometimes the financial policy is the cause and the corporate is the effect. So these are the interchangeable. Sometimes the corporate strategy due to some we have to change our financial policy due to corporate strategy, and even sometimes due to financial policy the corporate strategy has to be changed. So see, sometimes if we are I just give you an example. Suppose a company is want to enter into any business, new business, but we cannot. Our financial policy does not permit that we can go for a particular debt equity cross. We can cross a debt equity ratio. So in that case, the company may have to forego this opportunity. So this comes up both way. Okay. Now I'm just giving you a very example where these that will make you understand the interface of financial policy with the strategic management. Suppose a company wants to international market. Okay. So what are the strategic decisions we will need to make? This can be our market selection, or we can enter into the we can enter into the market through the acquisition route. Okay, we are acquiring any outside company in India to enter into the international market. But see, our financial policies, how our financial policy, it will impact our financial policy. We have to draft the policies to combat the forex exposure, foreign exchange exposure. Because once we enter into the international market, we have to see the risk foreign exchange exposure. Foreign exchange risk, that is a topic to discuss. And your chapter number 10 and chapter number 11, there are two topics are dedicated to this. Then next is comes the arranging funds. It is very important. So this can be our debt equity mix. Okay, leverage buyout. It can also be possible. Leverage buyout means when we borrow a huge amount to finance any acquisition. Then international sources. Okay, international ADRs or GDRs, etc. Then adjusting the debt equity ratio to absorb the risk. So all these are related to our, we can say that it is also related to the, these are interrelated. And one very important, when we talk about our just debt equity ratio to absorb the risk, here the topic comes out external funding requirement that we will discuss today on the next class. There is one topic external funding because we have to see, we have to when we are making an acquisition or even when we are making some growth, so we have to see how we will meet our funding requirements so that their risk could not increase that much. Okay, student. So this was our topic discussion on the how the interface of financial policy and strategic management are related. Now we are coming to the next one, that is balancing financial goal vis-a-vis the sustainable growth rate. Okay, I just draw it in a diagram as well. Okay, when we talk about this sustainable, okay, see the wall line, too fast, too slow growth will go against the enterprise growth and development. Okay, student, now when we talk about sustainable, this word is taken in the two senses. One is relating to our ESG senses. Okay. Sometimes it is used as sustainable growth, or we can say we have to sustain the environment. This is sometimes taken into sense. But when we talk about purely in a financial sense, so it is concerned with the that can be maintained. Okay, that can be maintained for the long term. It is very important because we have to see here how we can maintain our growth for a long time. Okay, so these are some prerequisite how an organization can make financially sustainable. Okay, have more than one source of income. Okay, do strategic action finance plan regularly, have a good public image, have a financial autonomy, have a generating income. So all points have aggregated financial system. So all these are topic points are there for this. But when we talk about sustainability, sustainable growth rate, the concept of how we determine the sustainable growth rate. Now, when we talk about sustainable growth rate, now let us discuss what is sustainable growth rate in a finance sense. Oh, okay, Gordon growth model. Okay, now what is this model? Because you recall that when you were doing your intermediate paper of financial management, this was one of the very important growth model there. Okay, or we can say valuation model is there. That is called Gordon growth model. Now, what is this formula is there? Okay. Now, if I talk about this formula, okay, this D0 is the last year's dividend. Okay, we have to see what is growth. And this growth is basically, we can say it is a kind of a implied growth. Okay, at current market price. At, and R is basically the cost of equity. Okay, R is basically the cost of equity. Generally, this is it is based on the efficient market hypothesis. That the market is efficient, they are discounting everything. So all these are I'm not discussing efficient market hypothesis here because it is covered in the topic of security analysis. There we will discuss in the detail. Only just keep in mind because market uh, determines this cost of equity after very all informed decisions. When we talk about this growth, okay, what is the formula of this growth? Okay, if you recall that, what is the formula? I uh, request the student just write in the chat box how we determine the growth. Okay, this is by your mind. Very simple formula was there for how we determine the growth. If we are not given the growth and we are given with the retention ratio, or we can say dividend payout ratio and return on equity. Please recall it. Okay. The formula was growth is equal to B into R, or we can say not R because it will be there. Okay, return on equity. Yes, now I have received. One second. Okay, yes. Now it is return on equity. Okay, so we can say that B means retention ratio. That is 1 minus D into return on equity. Okay, overall, when I talk about ROE, this is this formula you must have studied at your intermediate level. Please recall it. It was DuPont version. Okay, what it says, net income upon sales into sales upon total assets, total assets. Yes, very good. Prithviraj, very good. Okay, student. Now, if we analyze this formula, okay, somewhere it also help us, or we can say it also cut it out, like sales cut out with this, okay, total assets cut with this, and ultimately our formula comes like this: net income divided by equity. Okay, this is a called return on equity. Now, when I just see the growth formula, okay, this is also called, that's why it is called sustainable growth rate that I can maintain. I just writing this formula again. Okay, this much of portion I am repeating again here. So I can say like this: retention ratio, I can like this here, right here like this: profit minus dividend divided by profit. Of course, okay, this is my retention ratio into net. I do one thing, I just do it on a next page because I have to just show to you. 1 second. I'm repeating here. Net, I'm writing it like here: net income minus dividend Okay, student. So this is our formula. Okay, when I talk about this formula, Okay, so here if I see that, just I change the color. Okay, these two decisions, these two ratios are basically performance related. Okay, or we can say that it is also called return on asset. Okay, this is also called return on asset. Okay, on the other hand, these two are ratios are financing decision. Okay, because it determines how much equity for funding the total asset, how much equity we have to maintain, and here it is basically the dividend decision. Okay, accordingly, there is one term that is called also called. I am not. It is not mentioned in the study material. I'm just saying it is also called PRED analysis. It is also called the PRED analysis, where we use like R here. Okay, P is profitability. Okay, and here it is A asset base, and here it is total asset base. So it is also called PRED analysis, where we came to know how we company is performing or what is the role of the factor in a growth. So all this we shall do when we complete in when we will take up the assignment question. I will more throw light on this topic. So for the time being, we can continue our discussion on theoretical discussion, because it has been after the just we are starting with the break in the 5 to 10 minutes. Then after the break, we shall discuss the numerical assignment with you. Okay. Now, students, when this is your from the study material, SDR has been mentioned here, return on equity, 1 minus dividend payout ratio. Okay, so growth strategy. So all these theoretical portion are there. So what makes an organization sustainable? Of course, strategic direction, environment, and opportunity to work, able to interact with the competent staff, have adequate administrative and financial infrastructure, and able to drive. So all these are theoretical things. Now I am coming to the last topic of the day, external funding requirement. Now, when we talk about external funding requirement, what is all this external funding requirement? Student, external funding requirement, when we talk about it, basically we have to come sometime what happens. See here, one line has been mentioned. If you read this para, it will you will understood the logic behind this. Management may sometimes have a concerns about debt equity ratio or the current ratio in such situation to maintain certain level of growth. It becomes so it is very important certain level of growth. It becomes necessary to determine the amount of external funding requirement EFR and its type. Now, student, when we talk about sustainable growth rate, okay, so see, when we are talking about sustainable growth rate, so it means by making our financing decisions like how much dividend we have to distribute, we can decide that how much we have to retain and how much we have to distribute, and accordingly, what will be the return that will be plowed back in the business. So it is basically financing type of decision. So normally, what happens? I'm just discuss. I'm just drawing out a diagram that makes you understand. Now, if growth rate is given, growth rate we have to find out. It can be two type of a growth rate: internal and sustainable. Okay, when we talk about internal growth rate, it is basically return on assets into 1 minus D, that is dividend, because it let us know how much growth we can make. Okay, so in this case, when we consider this growth rate, we even make some additional equity. But when we talk about sustainable growth rate, it is that growth rate that that can be achieved without issuing the additional equity. But sometime some growth can be expected. Okay, when we can say that there is some likely to increase in the sale. So we have to see how we have to finance this increase in the sale or growth, and how to finance this growth. Then question comes, how to finance this growth that is expected. So this is called the external funding requirement. Okay, so when we talk about this external funding requirement, even we can understand it with the help of a one diagram. Okay, this is growth rate. Now, when we talk about this growth rate, see here the retained growth earning. Okay, here if we are employing back the retained earning, so we get the figure that up to this point we can say it is kind of a sustainable growth rate. Okay, this is kind of a sustainable growth rate because we know that if we retain this much, so this will be our growth rate. Okay, I'll explain the growth rate formula. The growth rate formula is ROE into 1 minus D, that is ROE into dividend. Okay, see this much of portion is retained. Okay, when this much of portion is of the, see the net profit portion that is retained is basically pertains to the equity. Okay, so whatever the return we are getting on equity, that is called return on equity, the same at a same rate we shall grow. That is called sustainable growth rate. In this case, what happens when we talk about the sustainable growth rate? No additional equity is issued. It is very important. This is a distinctive point. What are we are retaining? Okay, so or we can say that in this we have to maintain the that if we okay we go by the definition. Just let me okay when you sustainable growth rate is the maximum growth rate that a firm can achieve given the firm's profitability, asset utilization, and dividend point ratio. It is measured how much a firm can go without borrowing more money, or this can be calculated. So it means they are not borrowing any money. Okay, it means they are not borrowing any money. Whatever be the dividend they are growing, they are borrowing, they are at their own from their own funding. Okay, from their own funding. So this is, yeah, okay. Now see here, up till point, this is called our sustainable growth rate. But after that, sometimes I may be lying here, my growth may be lying here. So in that case, of course, this much of portion will be met by my retained earning. But balance I have to acquire. Balance I have to acquire from additional sources. Now, in this case, we have to consider the concept of external funding requirement. Student, here we are going for a small break. Okay. After this break, and this is there are two approaches. One is analytical approach, and another is formula based approach. So after the small break of say 10 minutes, we will come back. Okay. Okay, Megha, no problem. No problem. Even you can refer our recorded lecture. It will help you. Okay, student. We are going for a small break, and after this break, we shall come back. Okay, then I will discuss in detail this EFR, and then we start solving the numericals. Ashok ji. Okay, student, now welcome back. One second, I just check out whether I have received any query relating to the. One second. Huh? Okay. Okay, is it clear now? Okay, okay, start. Okay, student, welcome back. Now I am just checking whether I on query handle I have received any query or not. Just a second. Okay, just one query hasn't, I could not get in the system query handle. 1 divided by V, 1 divided by Bandi Kumar Rishi Reddy, 1 divided by last year dividend plus rate. Yes, Monica, yeah, you are correct, beta. Gayatri Tripathi. Sir, can you share the Zoom? Unable to join. Uh, uh, अशोक जी, आई थिंक तेरे एक स्टूडेंट का क्वेरी आया हुआ है कि वो कह रहा है ये है इसका नाम ज्ञानेंद्र मनी त्रिपाठी, and it is not able to join. It is saying, sir, can you share the Zoom ID number? I am unable to join through the Zoom. Is there any issue? Or they can student can join directly. Ganendra, please you try it. Okay. If still it does not work, please share your email ID. Okay, we will send you. फिर ईमेल पे भेज देंगे अशोक जी इनको हम. हाँ. Is it possible? चलो ठीक है, no problem. I am starting the class now. Okay, student. Now we are starting with it. One second. I think there are many chats are there. Okay. Now, student, when we were talking about this sustainable external funding requirement, and when we have seen that how much fund we have to generate from the outside, and what is from external sources, and in what proportion. Okay. Now we are starting with the assignment. Okay. So we are starting with the assignment for the today, and this assignment has already been hosted on the website. Now, student, I'm starting with this assignment. Please see the question number 1. Okay, please read this question. It says that following is the extract of the balance sheet and the income statement of FH Limited. Okay, extract for the financial statement for the financial year. Rupees, this is figure has been given in crore. Okay. Sorry. Okay, now this is our net income. Okay, now this is extract from the financial balance sheet of the 2 years, that is 2016 and 17 and 17 and 18. Okay, so this is just merely some information. It is not a maybe proper balance sheet. Now here in this, our liabilities have been shown like this here. Okay, this is our liability for the 2017-18. Okay, this is 16 and 17. Okay, now it says that calculate sustainable growth rate for the financial year 2018 based on the above information. Just we have to. Okay, so when it says we have to calculate sustainable growth rate for the above year, so formula is with us, that is 1 minus d into this, and but we have to draw out some data. Okay, we have to see how we work upon it. Let us see our working. So first of all, from this data, we have to calculate. This is the first part of the question. Okay, so for this, we need three elements. Okay, for the DuPont's model, that is first is profit margin. Okay, then we require asset turnover ratio. Okay, then we talk about equity multiplier. Or we can say financial leverage. It is also called financial leverage sometime. I think, one second, student, I have received one message. Okay, not an issue. Okay, so here let us start. What is our profit margin ratio? Our income is net income 18 and our sales is 400. Okay, so figure comes 0.045. No problem. Or we can say it is a 4.5%. Next is turnover. Okay, this is turnover ratio. It means our total assets. Now, when we talk about the assets, so student, please note that generally in this case, we can see that our sales divided by sales is our 400. Okay, our total assets is here 300. Okay, we shall take the last year data. Okay, we shall take the last year's data. Okay, this much of asset has been financed from this. So true. Now we come to the equity multiplier. Equity multiplier total assets means 300 divided by out of which our equity is 200. So it comes 1.50. Okay. So by this we get the figure. अशोक जी ये कुछ सिस्टम पे कह रहा है अशोक जी ये इसमें कुछ लिखा हुआ आ रहा है अलाउ मल्टीपल प्रेजेंटर टू शेयर but I have to click only one presenter can share at one time but whether I have to allow it or replace क्या करना है मेरे को अलाउ कर दूं ओके Okay, students. So this is our three data we have come across. Okay, now we shall see compute the return on equity. Okay, or 9%. Now we compute the sustainable growth rate. It says 1 minus sorry, I think I left out my one information. That is, students, sorry, I am skipped out one line. Here it says that 30% dividend need is declared. Okay, I forgot this information. If we can say that if the dividend payout is 30%, okay, then 9% it comes 6.3%. I forgot to include this information. Here one line I forgot to mention: net income. Calculate the growth rate of the finance based on the above information and assuming 30% income is distributed. Okay, students. So this is our sustainable growth rate. Now I am coming to the second question. This question is very important, and we please because here exactly how, in what sense we can use the sustainable growth rate and we can carry out the Pratt analysis, that will question let us know. Okay, it says the company X and Y are competitors in the same industry. Their latest financial statements are as follows. Okay, this is their latest financial statements. Okay, you are required to comment on their key growth drivers of the growth. Now, here the main use of sustainable SGR concept also come here, because sometimes it is said that of course from the sustainable growth rate we came to know how much we are growth, and from this we can compute our value of share, that is G value. But here another aspect, we come to know that how we can use the sustainable growth. So let us first of all compute their sustainable growth rate. Okay, so let us start solving the question. First of all, we compute the growth rate, that is of X limited and Y limited sustainable growth rate. Now profit margin, first of all we need to calculate the profit margin. It is our sales. Okay, it is our net profit. Okay, then we come to the asset turnover ratio. Okay, when we talk about asset turnover ratio, here it is sales, and this is our assets value. Okay, now we are coming to retention ratio. Next element. So if we see here, our dividend is 60. Here is a 2000. Okay, 60 divided by 1200 and 2000 divided by 5000. Okay, 1 minus. Okay, student. Now this is our retention ratio. So, and equity last column is equity multiplier. I think we should calculate the equity multiplier before. So our equity multiplier will be so student. Now if we multiply all these ratios, okay, sustainable growth rate. So we multiply all these values. Okay, the value comes 0.38, and here the value comes 0.0375. So now we can see that their sustainable growth rate is almost same. They are in the same industry and it is almost same. But now we have to analyze that what are their key drivers for the growth. So for this, we rewrite the formula. Okay, first of all, we compute the X limited. Okay, so I am writing down. One second, I have to see the chat. One second. Okay. Now here I say one second, students. X limit. When I talk about X limited, okay. So what I do start doing, I see what are their growth factors. Okay. See here the profit margin and asset turnover ratio, and here it is the retention ratio, and it is their equity multiplier. So what I am doing here, 0.10 into 0.8 and 0.95 into 5. So this value has come 0.038. Okay. On the other hand, if I write here Y limited, it is coming. Profitability is coming here. Okay. And it is 0.20 into 0.60 into 1.25. Okay, it is coming 0.375. Now, if I talk about, I have to analyze what are their growth factors. So I can see that here in case of Y limited, it is the profitability. It is the profitability contributing higher because my profitability is higher. or in case of Y Limited, asset turnover ratio is higher. So it means their performance is driven by the, we can say, their growth is driven by the performance. Okay, so it means growth driven by the performance. On the other hand, one second. Okay. On the other hand, if I see the performance of X Limited, it is major part is retention and a lower portion of equity. Okay, because out of 1,50,000, only 30% is financed by the equity, rest is the debt. So they are using the debt structure in a high level. Okay, they are using the debt structure at a very high percentage, whereas in case of X Limited, Y Limited, out of 1 lakh, only 80,000 is financed by the equity. So they are more secured. So here the financial leverage is on higher side. So accordingly, their growth is driven by the financing structure, financing factor, we can say that. Okay. Thus, we can say that, of course, their growth, although their growth is same, but there is a difference. Okay, there is a difference on the account of what are the factors contributing to their performance. Okay, student, it is clear now. Okay, now we are coming to the next question. Okay, that question is based on external funding requirement. Please read the question. It says that the following data pertains to ABC Limited. Okay, this balance sheet has been given to us for the year, financial year 31st. One second. For the financial year 2021. Okay, this is the income statement pertaining to 31st March 2000 year ending 2021. Okay, it says that assume that next year there will be an increase in the sales by 15%. Now here we have been given a kind of a growth in our sales. Okay, and this will lead to also increase in our profit as well. But here we have to analyze some factors. Then what would be the modified income statement first? Then also prepare the revised balance sheet of ABC Limited and analyze the external funding requirement. Okay, under following 3 scenarios, assuming increase in the sale by 15%. Okay, student. So now we have to see the 3 scenarios. Scenario 1, it says no change in fixed assets in proportion to sales and no dividend is declared. Okay, then second scenario is change in total assets. It means it includes both fixed assets as well as current assets. Okay, and proportion of sales and no dividend is declared. Then last is change in total assets in proportion of sales and 50% of dividend is declared. So these are the 3 scenarios, and we have to see how we can how we determine the external funding requirement. Now, students, please see that here our balance sheet is given like this. It is our current assets, and here it is our current liabilities. Please always remember one thing. whenever there is change in the sale, these current items will affect automatically in the same proportion unless and until something has been mentioned. If nothing has been mentioned, it will presume that they will change in the same proportion, because you know that when we were discussing the topic of financial management, in this case, it is assumed that a part of the current assets is financed by our current liabilities. Okay, so generally these are assumed that if we are selling on it, our sale is increasing, we are selling on a we are selling on a debt, or we can say credit basis. So of course we are also getting the goods, or we are also paying some wages in a lag of 1 month. So we are also getting more credit. So that's why we assume that both increase in the same proportion. Now let us start solving the scenario one. Now here there are two methods, students. Okay, there are two methods. One is analysis method, another is your another is our formula based method. First of all, I am preparing first part is modified income statement for the year 2022. Okay, now here the sales is, since our sale is likely to increase, our existing sales is 1 crore 35 lakh 80,000 plus 15%. Okay, less cost of goods sold. Okay, if I go back to the statement, it is there. So I take also in the same proportion, I consider their increase. Gross profit. Okay. Less indirect expenses. It will also increase in the same proportion. Okay, EBIT. Now here at the rate, we are paying interest at a rate of 12%. Okay, so our debt is 13 lakh. This our interest has been figure to given to us 1,50,000. So right now we are assuming that this debt will be continued from 1st of the year, financial year 2022 up to till it will remain the same. We are not changing it. Okay, so the debt remains the same. Okay, that becomes our earning before tax. Okay, now we come to the last, that is less the tax at the 42%. So it comes. So this is our earning after tax. Last figure is earning after tax, and that will also form the basis of our balance sheet. Okay, balance sheet as well as our external funding requirement. Okay, now I am preparing the external. Now I will prepare the modified balance sheet. Okay, when I will prepare the balance sheet, I will consider scenario 1 balance sheet. I think इसमें हो जाएगा. Okay. Now, first of all, we come to the in a scenario 1, there will be increase only in balance current assets only. So net fixed assets shall remain the same. Okay. Now current assets with 15% increase, cash, closing stock. Okay. Now next is equity. Equity shall remain the same. Okay. Whatever the earning is, the profit is there. Since we are not distributing any dividend, so it will be our retained earning. It will also form the part of equity. Okay. When I will write the long-term debt, I will not write figure now because it will be the balancing figure. Okay. Now here the current liabilities, 15% increase, accounts payable, Now total of this side comes 65,31,000. I write it here. Okay, now student, I request you just compute this figure. These, see, I have written here 65,000, 31,000. Now from this, these figures are available with me. Now I have to write the long-term debt. So please compute this figure. I'm waiting for the answer. Just do it on your calculator. Yes, very good. Nearby, I think Geeta, you have just a better nearby. I think you just, all right, let me check whether I have computed and written any figure wrong. You just, Geeta, again try it, beta. No, Pitambar, I think there's some error in typing. Let me check. 51,000. 1 second, 51, 750. Yes. No. What is? Let me check, beta. I think maybe I am written the wrong. 1 second. 43, 750, and it is 172,3905. Or it is whole. Now I am getting, see student, I think there is some, if there is any writing issue, or I just let you know the figure. This is figure is 65 lakh 31,000. This figure is 45 lakh. This figure is 17 lakh 23,000. 17 lakh 23,905. 1 lakh 43,750. Yes. Now Pitambar, you are right, beta. Okay. Now this figure is there. 1,11,595. Okay, friend. So what does it mean? Earlier, my debt was 13 lakh 30,000, but now this figure has been reduced to 1 lakh 11,595. So it means I have repaid some debt. How much debt I have refunded? That I compute it here. Okay, yes. Yes, Pitambar, you are right, beta. This much of debt I have refunded. So I can say that instead of externally funding requirement, I have rather repaid the external funds. Now this can be also computed by the using the formula approach. Now let us see the formula approach. Okay, the AFR formula is this is change in sales, this is liabilities by sale, and this is change in sale minus profit multiplier into revised sale 1 minus dividend. Okay, now accordingly, my asset upon this, see here my asset is how much asset my will change, because here my 15%, see what I can see here, that earlier, or we can say that it is kind of a change in asset. Okay, and this is change in current liabilities. and this is our profit retained. Accordingly, change in my current assets, see, my earlier figure was, balance sheet figure was 60,000. Okay, now my revised balance sheet is 65,000, 31,000. So it means overall my change in asset is 5 lakh this. Okay, here it is change in current liabilities. It is 25,500. Okay, then my retained profit is 17,000 lakh 905. Okay, now if I compute this figure, the figure comes negative, that is 12 lakh 18,405. It means implies debt refund, or it can be shown by this way. Existing debt less EFR. So this is our new debt position. Clear, student? Now I am coming to scenario 2. In this scenario, it says that total asset increase. Okay, it means not only the current assets as well as my current level physical assets are also increase. And when it is increasing, then I have to see how much external funding I will see. So again, I prepare a modified balance sheet. One second. Okay, again, I am writing here. I'm preparing the format of balance sheet. Okay, now I'm coming to the net fixed asset. This is my assets. This is amount. Okay, here it will also increase by 15%. So new amount will come 28 lakh 29,000. Okay, current assets, of course, as in previously, I have considered it as increase by 15% increase. Cash, bills receivable, and closing stock. Okay, now this time my total will become 69 lakh of the balance sheet, because if I see that overall my balance sheet, figure was 60 lakh, with a 15% increase, it becomes 69 lakh. I am writing the here figures and equity, it will remain the same. True. Here I am the retained earning. Outstanding expenses. Okay, now student compute this long-term debt figure, balancing figure. I'm waiting for your reply. Nearby, Geeta, just I think you're just reaching nearby, but I think there's some typing error or some calculation error, some small very. Yes, Pitambar, you are correct, beta. So this figure comes 4,80,595. So as I discussed earlier, our debt was 13,30,000. Okay, so here it is 4,80,595. So it means some amount of debt we have repaid. Okay, this much of amount of debt we have repaid. Okay, now when we say that it has been repaid, so let us see, we compute it by the alternative formula, that is our formula that we have discussed here. Okay, now let us see the alternative approach, formula based calculation. Okay, here it is revised sale into 1 minus D. Now this change is here, it's 9 lakh, because overall assets have been changed, minus okay, so this figure becomes 8,49,405. Okay, and our existing debt is Okay, now we are coming to the third scenario. Quickly, I am preparing the balance sheet. Okay, now I am preparing a modified balance sheet here. Meanwhile, you can also start at your own, because here this time only there will be one change, that is some dividend has been paid. Okay, now when I am paying some dividend, it says in the question 50% profit is declared as dividend. So the figure of retained earning will be changed. Revised retained earning will be now 50% of 17,23,905. Okay, so this will be the figure my retained earning here now. Okay, equity will be this much, 45 lakh. On asset side, okay, this is closing stock. Okay, the balance sheet total will remain the 69 lakh. This will be my balancing figure. Okay, I am writing the balance figure here. Other figures I am writing here. Okay, now I need your help. What will be my balancing figure? Yes, yes, you are right. The number you are right, madam. Any more answer? Yes, Chitra, you are right, beta. Yes, Chitra, you are right, beta. Now see here, student. Now figure my has come here, 13,42,547. Now I can compute my AFR requirement here. My new debt figure is 13 lakh 42,547 minus less existing debt. Okay, so my this figure comes 12 lakh. So it means this much of external funding requirement, or this much I can say it is this much of external debt I have taken. Okay, from outside because I have to meet this sales requirement. Okay, student. Now I can compute that way alternative as well. Alternative method is my with the formula. So I am again using the EFR formula here. Now dividend figure is same, that is 50%. So I'm retained is 9 this. Okay. So my AFR here comes 12 lakh 547. But this time this figure is positive. It means I have to borrow this much of a amount. Yeah. Now I can compute that way also existing debt. So this is my revised debt position. Okay, student. Now till now you have any doubt, please ask me. One second. I have to see whether I have to see. One second, students. I have to see my own. This Monica Jain. Yes, you are better correct. You have sent the correct figure. 69,000 when it will start. No. Monica, I think 6,69,000 you have sent the figure. I think. Or you want to say 69th that maybe. Okay. 1 second. So when the sale is increased, so the asset and liability, it means cash and either or credit. Yes, Geeta. If the sales are increasing, so asset and liabilities are increased, but if nothing has been mentioned, you will assume that all things will increase. because it is generally assumed that it will increase. Okay, if special generally, but it is always presumed that current liabilities will also increase, and it will also increase the cash, because the more cash come into the business. One second. Okay. Okay, students. So with this, we have almost complete two question now. There is third question has been there, but I think it will take some more time. We can do one thing. I'm coming to the one important part. That is, I'm just for the right now, I am just skipping the question number 3. What I am doing, I am discussing with you the one question that is from your assignment. That is question number 4. Okay, now when we talk about our, since we today from today's class we are discussing about that how we have to make planning. There is one very important part of financial management, or we can strategic financial management, that is refunding the old bonds and issuing the new bonds. Okay, this is one of the very important aspect. Now, when we talk about this aspect, recently I think there is one company, Vedanta Resources have even, I think they have come out with the resource that they are come out with they are issuing they are in the process of in a financial newspaper. There were one day there was news that the company is issuing the two type of a bond. I think it must be, I think Vedanta Resources are there, but I'm sure that Vedanta Resources are the name of the company. They were issuing two types of a bonds to repay the existing bond. Okay, so generally, this type of a decision is come when and why this happens. Generally, sometimes what happens, the debentures that have been issued way back in say 10 to 20 years ago may does not have the right now the interest rate may not be that much. So what the company do? The prevailing rate of interest may be lesser than that time. So they refund the high interest carrying debentures or bonds, and they issue the fresh bond at a lower rate. So I think student it will take some more time again. So what we do, we revise whatever we have done in today's class, so that before we end the class today, so it will also help. So student, we have started with the advanced role of CFOs in the value creation. As I told you, nowadays, it is our nowadays because since post-COVID, our the responsibilities of the CEO has multiple. Now, when then we have discussed the strategic financial decision-making framework. What are the various decisions, or we can say what are the main points, elements of that we have to cover in it? That is strategy, resources, and that is the right management team. Okay, then after that we have discussed this is meaning of the strategic financial management. Okay, relating to that is merger acquisition and valuation, etc. Then these are the financial strategy, financial management aspect. Okay, these all decisions you have discussed in earlier financial management paper. In the it is existing syllabus, that is advanced financial management, this portfolio decision will be covered. Okay, now what is this portfolio? It is just also called the diversification. Okay, as the companies are maybe now diversifying their investment portfolio, like in case of, as we have given the example, like Reliance, they have diversified into the away from the oil and petrochemical. They have entered into the communication, etc. So all these are during decision. Now it is one of the part of strategic decision making. Now then we have to make the go by the definition. Of course, we have to take the data of the previous accounting, okay, reports, and we have to have a forward looking, and it is a more dynamic because here the topic of strategic financial management involves decision analysis, or we can say we have to consider the decisions that whether yes we have to go or whether it is worthwhile to go. So we have to have a broader view. Okay, analytical aspect has also come to in our mind. Then we have discussed strategy at different level, corporate level strategy. Okay, that we design how we because it is a higher level strategy and they decide what they have to do. Okay, what they have to do to stay in the business, or we can say to meet the competition, etc. Now, business level strategy, how they have to equip themselves so that they could beat their rivals in the same type of product. Then it becomes a functional level. It means among the different functionals, how they have to act, because the strategy of one function maybe affect the strategy of the other as well. Then corporate level strategy that we have covered. Very good. We are coming to then financial planning. Okay. And in the financial planning, these are the basic three pillars: financial resources, financial tools, and financial goals. That's what we have to do. And when we are discussing the same, then we have to design our financial policies according to the same. Okay. Then it comes the balancing versus financial versus sustainable growth rate. Of course, sustainable growth rate, as I told you, it can be considered in two ways. One in the context of ESG and another is content of how much they have to sustain. Because see, too much slow or too much fast growth, both are quite not good for the organization health. Because if the company is growing at a very fast speed, so it increases the expectations of the stakeholders, shareholders, that this will growth rate will be maintained. Once there is any slower increase or where there is any slow, so it frustrates them. Now I'm just giving in this example, very good example, practical example. If I'm scoring in a board, say around 90 plus marks, so my appetite increases. Even my in BCom level, I would like to increase on a among 70 to 80%. Then in the C exam, my same expectation will be there. Now sometimes if anything goes wrong, then it really frustrates me why I could not score that much. Of course, C exam being a professional exam, so we should not lose the heart, and we need some introspection so that we can improve in the next attempt. Okay, then we come to the financial resources. These resources can be internal or it can be external. So now this decides our EFR. Here we can say it is also linked to our EFR. Then okay, now then it comes the financial methods to analyze the financial tools. This can be ratio analysis, planning tools, or valuation. So these are all tools we have covered. So these are not covered in the study material. I have just discussed with you for the sake of I think understanding of the topic. Now, when we talk about the financial planning, our horizon, or we can say that when we say that, 1 second, how much our goals can be short term, liquidity, medium term, and long term. So these are the objectives we have discussed, and these are the components and financial policy. And last, we have covered external funding requirement. So as I told you just before I winding up, bond refunding decision is also one of the financial. Of course, this top one question will also be covered while taking the topic of security valuation. Okay, this is chapter number 5. So there is the questions are coming there, but since this kind of a decision is also kind of a financial planning strategy decision, a basic question has been covered in this assignment. Okay, so advanced version will be there. There is one question is there also. So we shall take up in the when this topic will be taken up. Meanwhile, we shall discuss on this question in the next class. So student, with this, we come to the end of this session, today's session. Now, since as we are also arranging the open house session, if you know that this open house session for the paper of SFM AFM takes place on every Tuesday, 4 a.m. to 5 p.m. Okay, other than this option, since you are in the articleship, you may not able to attend the session. So you can also send your queries at this email ID. sfm-final@, or you can even contact me over the telephone 0120 is STD code there. Okay, and this is my this is contact number. So even you can contact at this phone. Okay, student. So with this, whatever in today's class have been discussed, please revise the same. And please, important to note that theory is not is also very equally important to score the good marks in the examination. So please don't ignore it and refer the study material. Of course, Saransh can also be referred, and these notes have been prepared from the help of Saransh that is available on the website as well. So, okay, students. So with this, I hope this today's class must be worthwhile to you, and I thank you for listening to this lecture patiently. Thank you very much. Thank you, Gita. Thank you, Beta. Or if you have any query, you can even ask me right now. Ashok ji, just open the session for the students. Student, if you have any query, you even can contact right now. You can ask me. Okay, Ashok ji, I think students, has any student raised the hand? Student, अशोक जी किसी ने हैंड रेस किया है? Okay. Okay, student. Thank you very much. Sir, if the dividend is to be paid, won't cash decrease? If dividend has to be paid, of course, cash will decrease. Okay, very good question. My cash will be decreased, but see, here your question is very good. Yes, yes, you are right. But Ashok ji, don't close the session. I just in the you're right, beta. We can do one thing. We can if I revise my solution, it will be cash return earning. If the cash is earning, of course, better I have to think it over. And your question is very good. Right now, I have to search out this possibility. Okay, but how will it impact the balance sheet? But your question is very good. Thank you very much for this question. Okay, Pitamba. Okay, Ashok ji. Thank you very much, student, and have a nice day. Yes. Over. I think there is no more query. Just on 1 or 2 minutes only. Okay.